Hi, and welcome to the June Buy-to-Let Mortgage Market Update. My name is Richard Pennell from The Mortgage Home, and we are your buy-to-let mortgage experts. So what have we got on the menu for June? We've got 4 items that I think you'll really enjoy. As always, to start with, what's happening with rates, Bank of England and mortgage rates. So that's my take. And obviously, we've got the election now, haven't we? So, yeah, that's a curveball that's going to, I'm sure, have some ripples. So there'll be my take on that. Now, here's the thing. Did you know 1 in 5 applications get declined because the property's not suitable? So what I've done is pulled together a checklist, my 5-point checklist, so that you guys will minimize the chances of you getting declined applications. It saves you time, energy, money. Why wouldn't you do that? So if you're buying properties this year, then listen to that section because I'll be covering that 5-point checklist. Smart companies. Now, I talked about it back in April. I touched on it and said I'd cover it in more depth. It took me a little longer to do that, which I'll explain later. But for those of you that are limited company owners and are thinking about smart companies, maybe you've never even heard of smart companies, and you might be intrigued, curious to know what they are, and is it relevant for you, then please just dial into that section because it is part of the evolution of SPV, special purpose vehicles. So I'll be giving you my take on that, and certainly from a mortgage perspective. And then finally, there's this myth that's always been circulating because I get these conversations and the team do every single week. Surely you cannot remortgage a property within 6 months of purchasing it. So I want to blow that myth out of the water. There's going to be 3 exceptions I'm going to talk about today. So again, if you're about to purchase a property and you think you might need to refinance within 6 months, don't despair. Listen to that section. In this piece, we're going to talk about the Market Watch, which is essentially looking at what the Bank of England are doing and ultimately what's going to happen with interest rates and how that knocks on with mortgage rates. So, quick recap. We have got rates still at 5.25%. So the Bank of England, even though the committee now at the last vote, 2 of the 9 members said they wanted a rate cut. So we're starting to turn that corner. And of course, there's a clamour for rates to be cut by the wider analysts and commentators in this area. But of course, the Bank of England have stuck their heels in, as we well know. And with the election now looming the next 3 weeks, then we are not going to get a rate cut at the next committee meeting. Now, I'm recording this on the 5th of June. The Bank of England committee will meet on the 20th of June. And I can pretty much categorically say that even if conditions are right for the Bank of England to reduce rates, I don't think they will dare to do that 2 weeks before an election. They will absolutely be hammered for that. So therefore, we're not going to see a rate cut until at least the following meeting, which is August. And that does rely on inflation continuing to go in the right direction. We've had a fantastic drop at the last inflation report. It dropped from 3.2 to 2.3, which is a significant reduction. And again, increases the volume from the commentators to say, come on, Bank of England, let's get rates dropped. But as I said, we're not going to see that, notwithstanding the election. But even looking beyond that, we're going to actually get a slight blip. I said this last month, that inflation, the next report is actually due out 1 day before the committee meets on the 19th of June. And I expect inflation to drop a little bit more. So again, this consistent dropping of inflation towards the target of 2% suggests that everything's hunky-dory in the right direction. However, here's the thing. We're going to have a blip. I said it before. Inflation's going to rise a little bit, maybe back up to 2.5%. Not much, but a little blip in the road. I think the Bank of England want to see inflation over that blip and back down again, and then be consistently heading towards that 2%. And in fact, next year it'll go below that before they press the button. So I've said it before, and I'm sticking with this. I don't see the election pushing this can down the road, I think rates will drop around August, September time. And I'm sticking with that view, even though we've now got the election in the mix. But what the takeaway message is, I do not see rates dropping sooner, certainly with the election for the reasons I've said. So if you're sat on SVR, my takeaway message is I would make decisions now, because even when the Bank of England drop rates, and that means that the lenders will start to drop their mortgage rates, we're only talking about a 0.25% of a drop at any one time. So let's say August, September is the first cut, and that's maybe when we see the first mortgage cut of 0.25%. We may see one further cut before we get to December. So in total, there might be a 0.5% cut by Christmas. But if you're sat on SVR right now and really hurting financially and paying 3 or 4% over the odds, then whatever you think you're going to gain, you're losing right now. I would make the decision, get onto a lower rate today. Even what I would consider, however, is taking a 2-year fix instead of a 5-year fix. Look, you've got to take a decision in the round. A 5-year fix may suit you for other purposes, but make sure that you look at the 2 years, because it might be worth paying a little bit more, because the 2 years are still being priced higher than the 5-year fix. So the 5-year fix looked compelling because clearly it's a lower rate, but I do believe that rates will drop towards the end of the year and will continue into 2025. So if you've taken a 2-year deal, you're getting a good deal now, but you should get a substantially better deal when you come to refinance next time round. And I think that is really compelling to consider if you're sat on standard variable rate right now and already paying those higher rates. But to give you some specific advice, you've got to book on the link below. There'll be the link to our calendar in the comments section. So if in doubt, what you need is personalized advice. What I'm giving you today is just generic commentary. You've got personal advice from a mortgage advisor. And if you don't have one you can rely on, then book some time in with a team and we will give you some ideas on what's out there right now for your circumstances to ensure that you save as much money as possible. In this section, I want to talk about valuations of properties. So this is when you're purchasing a property. And what I'm saying is you want to get it right first time. You want to be getting the right property that lenders are going to approve. And the reason I'm highlighting that this month is that I had a meeting with one of the senior lending managers at what is probably the largest buy-to-let lender in the UK, which is Nationwide and the Mortgage Works. And the guy was saying to me that 20% of purchase applications get declined based on valuation reports. In other words, the property is not suitable for lending. So if I can share that knowledge, that feedback with you, then that's going to save you time. It's going to save you money. It's going to save you energy. It's going to save you frustration. And you get to that correct property straight away that the lender's going to say yes to. So I pulled that information together into my 5-point checklist. So what you should be doing is getting a pen and paper, making some notes now so that you can have this checklist for when you're shortlisting properties, you know now what the underwriters are thinking so that you can chuck that property in the bin and not waste time on it. So let's get on with these 5 points. The first one is poor condition. So when a surveyor goes to a property, one of the questions they're asking themselves is this property in a lettable state? And it's a really difficult question for me to succinctly answer. There's no standard definition of what a lettable state is. But if you walk into that property and the condition of it is such that it looks really, really outdated, that we need the carpets updating, we need full decoration of the property, and the fixtures and fittings are really basic, really old, just about functional. And it might be in your head as a landlord, you say, yeah, but there will be some people that will probably rent it. Now, that suggests that these are more desperate people, people that are, I suspect, on social housing, maybe the vulnerable people, I don't know, but people who don't have a lot of choice in life and will take what they can get. Well, that's not the type of property that a lender wants, and the surveyor knows that, and that therefore they may well take that view that it's not in a lettable state and decline it. Here's some indicators. If you're looking at a potential property to buy, and there's over £5,000 worth of work to do. Look, this isn't a definitive figure, by the way. This is just for you as a bit of a ballpark. But if when you do the maths, there's more than £5,000 worth of work, then I would be quite concerned about whether that would get through the surveyors and be seen as lettable, because the lender wants that property to be let pretty much on day one. Yes, they will allow for a little bit of cosmetic work, but pretty much they want that property good to go. They want you advertising it. They want the income stream coming in, the rental, because that's actually servicing the mortgage debt. So if there's more than £5,000 worth of work, be concerned. If the work that's required is spread across multiple trades, is another indicator. So I'm still on poor condition here. But again, if there's multiple trades required that you got to bring them in to get the works done, then again, that's an indicator that the lender may well decline the case. So that's poor condition. Proximity to commercial. Sadly, I see so often that lenders will decline a property because there are certain types of commercial premises, not necessarily next door to the subject property, but on the street. I've seen examples such as haulage or that type of industry where you've got large wagons, HGVs, up and down the street. So it can be really off-putting for a potential tenant. So therefore, you've got noise, you've got the heavy traffic. You've also got commercial that might have noises and smells. So you might have laundrettes, you might have pubs, you might have takeaways, anything that's open on an evening that's going to attract sort of people onto your street. Again, lenders and their surveyors will take quite a dim view of that. And of course, we've got the technology now to get on Street View. We can walk up and down the street virtually and check that out. There's no excuse for saying, well, I didn't realize there was this type of commercial a few doors away. So as part of your due diligence, your shortlisting, get on Street View and have a little wander around if you don't know, but be really looking for if there is any commercial type properties on your street and adjacent or reasonably close. If in doubt, then as brokers, we sometimes can take a view on it because we're not surveyors, but we've got experience in that area. And we've also got a number of lenders. Now, this is a real great service that some brokers understand that these lenders offer this, where they've got an in-house survey team. So we're not spending time and money on a full application. We're not paying for a survey fee, but we can give, let's say, a link to Rightmove to the in-house survey team, and they'll give us a bit of a heads up. Now, that could be really, really valuable. So there are some lenders that offer that service. Now, on to my third point, and this is a really unusual one, that there's 50% owner-occupiers in the area. Now, what on earth are lenders going on about here? So I've got to be careful. This could be a sensitive topic here, because what lenders are trying to say is, if you've got an area where 100% or getting on that high percentage of the area is as dominated by tenants, then that may well be a deprived area. It may be a poor area, and therefore it may then draw in the wrong crowd. It might be that there's also, it's going to drive away potential tenants. So lenders are looking for a good mix of owner occupiers in the area. And I'm saying area, not the streets as well. There's exceptions to this, by the way. There are lenders that say that we don't have such a rule, but there's a general rule that's in place. So how, as a landlord, do you do your due diligence and pull that statistic together? So there is a website called Street Check. So I'm just double checking that I've got that right myself. Yep, www.streetcheck.co.uk. If you put that in the address bar, go onto that, there'll be a little field saying put the postcode in of the street that you're interested in. So you put that in to start with, click on search. Then you get a series of tabs appearing. And one of those tabs is called housing. Click on the housing tab and then just scroll down a little bit and you will see a pie chart and some data on an analysis of the type of occupants in the vicinity of the postcode. This is exactly the data that you're wanting. Now, within that piece of data, it will say how many properties are owned outright, how many properties are owned with a mortgage, and if applicable, how many are shared ownership. So those first three you add together to give the number of owner occupiers in the area. And then if you scroll a little bit further down, you'll see the total units in that area. And literally, you just do the maths. So how many owner occupiers and shared ownership as a percentage of the total. And if that's around at least 50%, then you know you can tick that box on your checklist and you can move on. If it's less than that, doesn't mean you throw it in the bin. If it ticks every other box, then it might be something to consider. But you've got some alarm bells. So you should then be raising that with your broker to say, could this be an issue? And again, a really good buy-to-let broker can do some research with potential lenders that may not have that rule in place so that we don't have any issues further down the line. So it's a real rule that a lot of lenders will have in place, but that's how we get some transparency on that, get the data so we can make some decisions on it. Shared accommodation. Now, I'm not talking about HMOs here. I'm talking about possibly student lets where you've got sharing a house and it's on one tenancy agreement. So that's a scenario we see it a lot. Usually students, not necessarily, but tends to be the typical use of that type of property. But it's not a HMO. So when you've got these a four-bedroom property, you've got lenders will lend against that. But here's the thing that you want to make note of. If this is a property that you are looking to buy, lenders will not like the fact that there will be locks on the bedroom door. So if you're looking to buy a property that's 4 bedrooms in a sort of a student area, you are looking to let it out on one tenancy, but to 4, maybe, pick students that know each other, then make sure that there's no locks on the bedroom door. The other thing that you're looking out for is that there's some communal areas. Now, that could be a living room or it could be a dining area, but a lender will want to see that there is some communal living space over and above the bedrooms. Quite often we've seen that landlords want to maximize the rental. Of course they do. So they've converted that living area into bedroom number 5, for example, so that you get another 20%, 25% rental income coming in. But that can cause an issue with many, many lenders that want to see that we're not trying to just squeeze too many tenants in and that there is that nice balance with some communal areas. So again, when you're doing your going through your checklist, make sure that's on there if you're looking at that type of property. And the last thing is, don't be just thinking that a surveyor is going out to put a market value figure on the property value. He or she is also assessing what the rental value is. So whatever you think with your rose-tinted glasses on, then be mindful that the surveyor's going out there and it's their valuation. Usually, there's exceptions to this, but usually it's whatever the surveyor thinks is the typical market rent for that property. So again, from your point of view, not only you want to be checking, of course, that you're getting the right return on your investment, but the rental figure, is it strong enough to get the borrowing that you need? And again, what rental figure are you using? So please, please, please don't be putting in the maximum rental figure that you hope to obtain when you get this property. You want this mid-way rental valuation because that's likely where the surveyor is going to be putting on the report and what the lenders are going to be used to determine how much you can borrow. So how do you determine that? Well, when you're doing your research and you're going onto Zoopla, Rightmove, or maybe you're speaking to local letting agents, then you want to be looking at comparables, because that's, again, what the surveyors are looking at. So if you think about a map of the local area with your property right in the middle, and you're drawing a concentric circle around that, then you start off by looking at the adjacent streets that your property's in, and seeing if there's properties that have been rented recently. Now, notice I've said being rented, not for rent, because if they're on Rightmove saying, here's a property for rent at £900 a month, but actually it's not yet been rented, then the surveyor will ignore that comparable. There has to have been already let. And here's the thing, write this down, it's within the last 6 months. So don't look back any further, because surveyors won't be doing that. So we want to be comparing like for like. We want to be comparing in the way that the surveyor's going to be comparing. And so, well, how do I find that info, Richard? Well, this is where you should probably put a little bit of extra effort in and actually go into the letting agents. If you go in there and say, I'm thinking of buying this property and I need a good letting agent to manage it, and I wanted to chat to you, would you be open to managing this property for me? Clearly, you've got their interest, and they will be very, very keen to share with you other properties that they're managing in that local vicinity and what price and what rental they're getting for it. So that's how you get that piece of data to inform your decision about what the typical rent is. Great. Then if you can push that up a little bit more, maximize it, then that's great. But for your due diligence, then you're going on this midline, this average rental figure, and that's how you collect that information. So pull that together into that 5-point checklist. It will serve you well. But even if there are boxes that you're not ticking, talk to your broker, because there's always exceptions to rules. And that is the takeaway message. If it ticks every other box, maybe you're also getting it at a great discount. So you're prepared to or want to turn a blind eye to one of these 5 points. But I've said that really, that might mean a decline. Talk to your broker, because we might be able to sidestep it. We might be able to find lenders that actually are more lenient and more flexible about that particular area. So again, if you are interested in anything we've just said there, if you've got properties that you are already shortlisting and are thinking, well, should I just submit the application and let's find out? Send us that information ahead. Click the link on the comment below, book some time with the team, and send us that information, and we'll really get under the surface and understand that property in detail, so that we can give you some real good quality feedback as to whether that is likely to be a property that's accepted by the lender. I hope that's been of use to you today. As I said, there's comments below if you want to chat in more detail with the team. In this section, I want to talk about smart companies. Now, they are the new kids on the block. These are evolution of limited companies. Now, limited companies really exploded in 2016. We had the Finance Act. Section 24 of the Finance Act 2015 came into being, and that really opened the doors for us landlords because of the issues and challenges in how much you could claim in terms of interest when you own properties in your personal name. So limited company was a way of sidestepping that penalty, as it were, in terms of the limited amount of interest you could claim when you were a personal, when you own properties in your personal name. So own the properties in the limited company name, the shackles are off. There is no Section 24, and you can claim 100% of the mortgage interest. You all know that. So that was 2016. And if we fast forward to today, in our company, I would say 1 in 2, 50% of all purchase applications are now done within a limited company. So they've really, really now been embedded within the landlord psyche. They understand that, the landlords, they get whether it's right for them. And as I said, most landlords have a limited company and are certainly using them for their purchases. So before we talk about smart companies, I really want to just talk about a bridge, really, between the original SPV and smart companies. We've got SPVs with alphabet shares, and I want to talk about that because then that leads into smart companies. So Best way to describe this, if you've not heard of alphabet shares, and if you've not, but you have got a limited company, then you should be taking some notes down because this could be really, really important for you, really useful tax mitigation um, strategy that allows you to get more of your profit out of the company. Because these alphabet shares, let's start off with the very basic. You've got Mr. and Mrs. are joint owners of the company. They are joint shareholders. They have one share each. And these are called ordinary shares and they are A shares. And that allows Mr. and Mrs. to control the company and vote on the direction of the company, the strategy of the company. Sounds very formal. It's probably done over the tea table, but from a legal point of view, that's the shareholders coming together for a meeting and making a decision about the direction or strategy, as I said, of that company. You can only do that if you own an ordinary A share. Now, so why would there be a new category of share, which would be called a B share issued? Because, as I said earlier, the Mr. and Mrs. might want to issue this new category of B or C or D share to perhaps family members, or perhaps where it has also been used in trading companies to give to maybe key members of staff, senior management. And that, as I said, allows the ordinary shareholder, the A shareholder, to issue dividends to other people other than themselves. So if they want to issue dividends and reward family members or reward senior employees, but you don't want to issue A shares because all of a sudden they become an owner of the company and they can partly control the company and they can vote on the future direction of the company. You may not want your kids to do that. You may not want your employees to do that, obviously. So you need to introduce a different category of share that doesn't have those rights, those controls, etc., but it does allow the dividends to be issued. So if you've never come across those, that is a really a tax efficient way of getting money, getting profit out of the company through a dividends issue, but to those different category of shareholder. So that leads me nicely then into smart companies. So usually a smart company will have these alphabet shares within them, but it takes it now a step further. So the new category of share that a smart company has are called growth shares. And the real reason these growth shares are there ultimately is to avoid inheritance tax. That's so let me explain. So let's go back to my example. We've got Mr. and Mrs. that are the main owners of the only owners of the SPV that's got 3, 4, 5 properties within it. And it's done, they've done what they've needed to do, and they've gone into retirement and they're living off the rental profits in retirement. And then ultimately, as will happen to all of us, both parents eventually pass away. Now, normally that SPV with the properties goes into the estate. If the kids don't want to run the company or the portfolio, then the portfolio is sold and the proceeds of the sale go into the deceased estate, forms a pot of money that may be eligible for inheritance tax paid, and then the kids get the cash out of it. With these growth shares, when the properties are actually sold, the profit, the growth, is allocated not to the A ordinary shareholders, not even the B or the C or the D shareholders, but get allocated to whoever has the growth share. And it's a trust that owns the growth share. And I'll talk about trust a little bit more in a second. And the reason it's in a trust is that, therefore, the proceeds of the sale, remember my little example that the kids don't want to run the property empire, so the portfolio is going to get sold, then the proceeds of the sale don't go to the individuals yet, they go into a trust. The trust is run by trustees. The trustees have the beneficiaries nominated within the trust document, which is the kids, let's say. So then the trustees pay the proceeds out via the trust to the kids. So the kids get the money, but it's what it has done is bypassed and sidestepped the deceased family estate because it's gone into the trust. It's outside of the estate. Therefore, it's outside of any inheritance tax calculation. And in fact, if you think you might have heard of this before, I've talked about this a number of times on my updates, where life insurance, if it's not, should be put inside a trust. It's the same type of discretionary trust. And the reason you put life insurance in a trust is for the exact same reason, is that when it's claimed upon, when mum or dad pass away, and the life insurance is triggered as a claim and the insurance company pay out, because the life insurance is sat in a trust, the insurance company pay the proceeds to a trust, not to the deceased estate. And then the trust pay it to the beneficiaries. Therefore, it's sidestepped inheritance tax. Didn't want to get into insurance on this, but there's real parallels here. So that's why these SPVs are now moving into the realms of what are being described as smart companies, where there's this new category of share. Now, here's the thing. This all sounds great. Hopefully, I've explained it succinctly and you understand it. But then we've got the reality of between now and your parents passing away of still being able to refinance properties, being able to purchase properties. And what's the lender's take on this? And right now in 2024, it's such a new thing that there's a real limited appetite to lend to these smart companies. Now, don't misunderstand me. I'm not saying that lenders will not lend on smart companies. There are a number of lenders that will, but they are definitely the exception to the rule. So there's a real limited small number of lenders, which may mean, not necessarily, because within this small short list of lenders, there are some that are competitive, but there are some that will charge you a little bit of a premium. So if you've got other issues and challenges going on, we may end up going to that lender that will charge you a little bit more. But right now, there's a real limited appetite to lend to smart companies. And here's the point that when I've been speaking to lenders, as I do about these, do you know what? It's a lack of it's ignorance. It's a lack of understanding about what these smart companies are there to do. As soon as lenders quite often hear the word trust in association with a limited company, then the shutters come down. Whereas I think over time, when these things start to get momentum and the lenders are prepared to really understand what these smart companies are about and that there isn't really a risk to them, I think we'll find more lenders coming on board. But right now, we've got this limited appetite. So the takeaway message is, don't despair. If you've already got a smart company, if you think, well, actually it makes sense for legacy, succession planning, inheritance tax planning, for me to have one, don't be put off by what I've said. But what you must do is talk to your broker team so that you see that there are still options for you with lenders, still ways forward, so that you can still continue to refinance, still get best deals. And if you're building a property portfolio still, that's not going to be hampered. So, the devil's in the detail with this thing. And it may be over the next year or two. I don't see things changing in the real short term, but more in the midterm. I'd like to think that lenders will embrace this type of company a little bit more. So, look, if you want to understand this a little bit more than what I've just said in these last few minutes, then there'll be a link on the comments below. Click the link, book some time with the team, and they'll talk to you a little bit more about smart companies and, again, how that might impact you from a lender point of view. In this section, I want to talk about day one refinancing, or as it's also known within the landlord circles, refinancing within 6 months of ownership, because I hear every single week landlords saying to me, oh, once you bought a property, you can't refinance for 6 months, can you? You have to wait 6 months before you can remortgage. And And I really want to dispel that myth today because there's 3 exceptions I want to talk through. So again, if you want to write this down, because this is important, if you are thinking of buying a property and it's possible or likely that you may want to refinance sooner than later, then you want to be making some notes on these 3 exceptions. So exception number 1 is where a typical example might be if you've inherited a property or if you bought a property for cash. Let's say the reason you bought it for cash is that the vendor really wanted a quick sale. Nothing wrong with the property. Maybe there's a lot of demand for it and you happen to be in a position where you have the cash to buy it outright. So you say, look, I'll buy it for cash and I'll complete within a few days or a couple of weeks, just so that you secure that property because it really did suit you. Maybe it's the location, maybe it's next to schools, whatever it happens to be. So those are sort of 2 examples of when you might be buying for cash, but then you want to pull that cash back out, don't you? Or if you've inherited it, you then might want to take the equity out and, maybe distribute it amongst family or use it for some other purpose. And you don't want to wait that 6 months. So there's the first tranche of lenders that say, we're okay with that. If we'll allow, if you, let's say you acquired that property for £200,000, then we'll allow you to refinance that and we'll use £200,000 as the market value. Even if you might think it's worth more, the lender says, £200,000, that's what you bought it at. Or if you inherited it, that's the value that we put on it at that time, or goes on to land registry, then that's the figure that we will use to refinance. And if it's a buy-to-let, then you probably get 75% of the 200K, so you can maybe pull out 150,000. And for some of you, you might be really happy with that. As long as you get that 150K out, that suits your purpose, and on you go. Okay. Now, what about properties where you want to add some value to it? Let's say, there's cellars, there's attics to convert. Maybe there's bedrooms to split. Maybe you're putting extensions on. Maybe there's some structural issues that you've needed to fix. So you've done a real good chunk of work to add value. And you want to pull some of that value back out. Now, I'm splitting this now into 2 sections. The first section is we've got a chunk of lenders that say, yes, we'll consider that scenario, but here's the thing. We want you, Mr. or Mrs. Landlord, to give us the invoices from the work that's been done on the property. So you bought for £200,000, you've done £20,000 worth of work. You've got £20,000 worth of invoices. So this category of lender says, we'll assume the value to be £220,000. We don't care. We're not going to listen to you if you think that it's worth 250 or 300. We're just going to add the value, the material value of the works that you've done. So 220 is the figure that this category of lender uses. And again, if you're happy with that, you just want to pull back out some of the extra costs that you've put in for materials. Well, I'm saying materials and labor. If you've had an invoice, they're not just going to extract just the material cost alone, but those invoices for work done. So that, as I said, amounts to 20,000 quid. So they will say, okay, the property worth 220. And if it's a buy-to-let, then as long as the rental's strong enough, you should be able to release 75% of £220,000. And again, so that's exception number 2. If you're happy with that, then we've now expanded our shortlist of lenders. Then finally, we've got exception number 3. Now, this is the ideal version. This is the holy grail that lots of lenders, when they're doing this type of work, quite often what's known as BRRR type properties, which is buy, refurbish, rent and refinance, then you might want more than just the cost of the invoicing. You say, okay, I bought for 200. Let's say I've done 20 to 30,000 pounds worth of work. However, this property all day long is worth 300,000, and I need to get 75% of 300,000, which is what, 225K, which if I could manage that 225 is my full purchase price plus the cost of works, which means you've got your money back. It's a no money down deal at the end of the day. You've got all 100% of your cash back out of the property, which allows you to repeat the process and build your portfolio at a quicker pace. So the good news is there is a small category of lenders that say, if you've done some chunky piece of work and it's still within that 6 months and you think it's worth 300,000, then put 300,000 on the application and we'll give that to the surveyor. We'll give them a list, a schedule of the works that you've done to the property. And again, as a broker, I would be saying to you, Mr. and Mrs. Landlord, give me as much information about what you've done as possible, to demonstrate that added value that you're now, where the belief that it's now worth 300,000 from. That may also include comparable properties to add to that data that we want to give to the lender. But essentially, we give them the schedule of works and they will pass that on to the surveyor, who will then determine whether they believe also that that property is worth 300. And this category of lender, if the surveyor says, yes, it's worth 300, we'll give you 75% of the 300K, so long as we tick all the other boxes and about affordability, etc. So those are the three exceptions. Hopefully that's been of use here. If you are thinking of buying some properties where this might apply and you want to talk through in more detail, click the link below, book some time on with the team, and we will then give you some real focused advice on that specific property for you, so you are in an informed position and you can make some decisions. So I hope that has been of value to you today. So just to summarize and finish off this month's update, this last slide just gives you a summary of our company services. As you can see, we've got everything to do with protection, life insurance, critical illness. We'll do short-term financing with bridging, as semi-commercial, commercial, and then all the usual type of investment mortgages that you would expect to see from a broker: HMOs, multi-units, buy-to-lets, holiday lets. So anything to do with bricks and mortar is what we do. So hopefully we can be of use to you in the future. But that aside, thank you so much for watching to the end, and we'll see you on the next update.